Breaking quietly but with real consequences. A new IRS reporting shift is changing the way retirement money is recorded, matched, and questioned, and it can reach further than many seniors realize. If your income includes Social Security, SSI, SSDI, VA benefits, pension income, retirement distributions, or any form of federal support, this update can influence your money, your tax filings, and the benefit-related protections tied to eligibility, so it is not something to shrug off. Here's the twist. The Internal Revenue Service has rolled out changes that are already shaping how income is reported, how payments are tracked, and how certain financial safeguards are evaluated. And that makes retirement finances more complicated than many people expect. A lot of retirees assume that once the paycheck stops, everything becomes simple. But newer reporting standards and compliance expectations are making post-work budgets feel more intricate than they have been in years, which is why it matters to understand what is happening, why it matters, and how to avoid an expensive misstep. For a long time, the routine felt familiar. A Social Security deposit or a pension arrives, a tax form shows up, and filing season passes with minimal drama. Now watch this. The financial world has shifted quickly. Electronic payments replace paper checks for many Americans. Banks share more data with federal agencies. Retirement accounts are monitored with greater precision, and even small side income, often used by seniors to keep pace with rising living costs, draws fresh attention from tax authorities. The IRS frames these moves as a push for accuracy and fraud reduction, arguing that stronger reporting can help prevent identity theft, stop improper payments, and make sure benefits go only to people who qualify. That may sound reassuring, yet the transition sparks confusion across the country. Tax professionals say many older Americans do not realize the rules have shifted until an unexpected notice lands in their hands, and that surprise alone can feel like the floor moves under you. One major misunderstanding is the idea that Social Security is automatically tax-free in every situation, because that is not always the case. Depending on total income, some portion of those benefits can become taxable. What makes the newer IRS approach especially important is speed. Income is being matched and verified faster than before, and when something fails to line up precisely, automated systems can flag it without hesitation. Picture a retired couple living mostly on Social Security who withdraws a little extra from a retirement account to cover medical bills. In the past, that kind of transaction might not have drawn immediate attention, but under automated reporting, those moves often connect almost instantly. If the couple misjudges how that withdrawal changes taxable income, penalties can appear later, even though they never meant to do anything wrong. And that is why financial experts describe this as a silent change. It does not always arrive with loud headlines or a flashing warning. Instead, it quietly reshapes the way retirement income flows through the tax system and tightens the margin for error. Another layer in this story is inflation. Everyday expenses have climbed significantly, and housing, groceries, utilities, and healthcare place heavy pressure on fixed incomes, pushing many seniors to get creative to close the gap. Some rent out a room, some sell items online, and others take part-time or freelance work. These choices can help, but in a stricter reporting environment, even modest earnings are less likely to pass unnoticed. That does not mean retirees are doing anything improper. It simply means transparency is demanded more consistently, and analysts emphasize the aim is clarity rather than punishment, even though mistakes can still happen when people do not know the rules. And once an error enters the system, fixing it can require time and patience, which is why the emotional impact of an IRS letter should never be minimized. Many seniors describe those notices as deeply stressful. The official language can feel intimidating. Some people immediately worry about losing benefits, and others fear an audit. In most cases, issues can be resolved, but prevention is almost always easier than correction. To see why the update carries so much weight, it helps to zoom out and look at how retirement finances evolve. Years ago, many people relied on three pillars: Social Security, a pension, and personal savings, while the modern picture is far more varied. Traditional pensions are less common. Retirement accounts like 401ks and IRA play a larger role, and investment income, dividends, and required distributions all enter the equation, each producing its own documentation. The IRS now processes that information using advanced technology designed to spot inconsistencies faster than ever, which raises the stakes for keeping records straight. Consider required minimum distributions, often called RMDs. Once you reach a certain age, you must withdraw a specific amount from certain retirement accounts each year, and missing that requirement can bring significant penalties. In a more precise enforcement environment, overlooked withdrawals are less likely to slip through the cracks, and while banks and custodians may send reminders, the responsibility ultimately stays with the account holder. Professionals warn that overlooking a distribution can be one of the most expensive retiree mistakes, and the IRS has shown increasing focus on compliance in this area. Driving much of this is the federal government's broader modernization push, where paper-based processes give way to digital infrastructure. Electronic filing is standard for millions of taxpayers, and direct deposit becomes the preferred route for refunds and benefit payments. Efficiency improves, but data also moves faster, meaning there is less lag between the moment money is received and the moment it is recorded, which can feel unsettling for seniors who value predictability and steady routines. Retirement is supposed to bring stability, yet financial rules keep evolving, and advisors often compare tax awareness to overall retirement health, like keeping up with regular medical checkups. Staying informed does not require becoming a tax specialist. It means accepting that rules can change and taking time to understand how those changes connect to your own income mix. There is also a psychological and safety angle. Many older Americans grew up when government communication arrived mainly through the mail, but legitimate notices may now appear electronically, and scammers sometimes mimic official messages. Because new reporting structures can create uncertainty, criminals exploit that confusion with alarming emails and urgent phone calls, claiming a tax issue must be handled immediately, and seniors who have not heard about the updated rules can be especially vulnerable. Remember, real agencies typically provide formal written communication and allow time for response, so panic is rarely necessary, and rushing can create bigger problems. Another connected area involves estimated taxes. Some retirees receive income with no automatic withholding, which can make quarterly payments necessary, and skipping them can trigger penalties, even if the final tax bill is paid later. The challenge is that retirement income can fluctuate, and a larger withdrawal in 1 year, a property sale, or unexpected investment gains can temporarily push someone into a different tax bracket, leading to an unpleasant surprise without careful planning. Experts often describe retirement taxation as a puzzle where every piece influences the others. Social Security interacts with investment income, withdrawals affect taxability, and even Medicare premiums can shift based on reported earnings from prior years. So when reporting becomes more exact, that puzzle demands more attention. Even with all that, the point is not to scare you. Knowledge is power, and millions of seniors manage tax season successfully, especially when they understand the ground rules. Think of this as a prompt to review habits. Keep key documents organized, know where each stream of income comes from, and plan withdrawals thoughtfully rather than making impulsive moves, because small adjustments can prevent major stress later. Many retirees feel calmer working with trusted professionals, but even people who prepare their own returns benefit from reading notices carefully, keeping records, and filing on time, since those basics still protect peace of mind. Another encouraging detail is that the IRS expands educational outreach, recognizing that transitions can be confusing, particularly for older taxpayers who may not track policy shifts closely, and efforts are being made to clarify expectations and reduce misunderstandings. Even so, awareness spreads slowly, which is why so many seniors remain in the dark about this rule, and why it is useful to explore how reporting changes connect to benefit programs, why timing matters more than many people realize, and what financial behaviors can unintentionally trigger headaches. Retirement should center on enjoying the life you worked hard to build, and protecting that life includes staying ahead of financial changes even when they arrive quietly. The new IRS rule is not something to fear, but it is absolutely something to respect, because ignoring it can lead to penalties, delayed refunds, or complicated corrections, while paying attention helps keep income secure and benefits steady. Across the United States, financial advisors and retirement planners see a pattern that is hard to ignore. Seniors are not deliberately breaking rules, yet small reporting mistakes are being discovered and then ballooning into bigger problems. The newer enforcement approach is not necessarily harsher, but it is far more precise. And that precision means discrepancies that once took years to surface can now appear within months, sometimes even sooner, leaving less time to react. A common scenario involves retirees who assume their financial life is simple because there is no traditional paycheck, but retirement income rarely comes from a single source. A monthly Social Security deposit can sit alongside a pension, a retirement account withdrawal, investment dividends, or occasional consulting work, and when each piece is reported separately and then matched electronically, accuracy becomes critical. What surprises many older Americans is how small decisions can shift the tax picture. One larger withdrawal to repair a roof, help a grandchild with tuition, or cover unexpected medical costs can raise total income for that year, which may cause more Social Security benefits to become taxable. That same jump can also influence Medicare premiums later, because those premiums are tied to income history. So the problem is not the withdrawal itself, but failing to anticipate the ripple effects that follow. Professionals often say retirement planning is no longer only about saving. It is about managing how money is distributed over time, and the IRS update reinforces that timing matters more than many people assume. Taking funds too quickly or without accounting for tax impact can create financial pressure later, even when the original reason for the withdrawal is understandable. Another topic drawing attention involves digital payment platforms. Millions of Americans use electronic services to send and receive money, and many seniors adopt these tools for convenience, helping family members, selling personal items, or running small home-based businesses after retirement. The IRS increases focus on how certain transactions are documented, and while personal transfers generally remain separate from taxable income, payments tied to goods or services are often reported, which is where confusion can hit. Some retirees assume smaller amounts will not be noticed, but under modern reporting systems, documentation is far more thorough, and counselors stress this is not about discouraging seniors from staying active or earning extra. Many retirees enjoy the independence supplemental income provides. The message is simpler. Transparency protects you, and recording income correctly prevents stressful corrections later. There is also a growing conversation about withholding. During working years, taxes are typically pulled from each paycheck automatically, but in retirement, that structure can change, with some benefits allowing voluntary withholding while certain kinds of income do not. Without adjustments, retirees can reach tax season and discover they owe more than expected, and that shock can feel intense for someone living on a fixed budget. Yet, the situation usually builds gradually rather than appearing out of nowhere. It often begins with the assumption that everything is being handled somewhere in the background. And the new IRS rule highlights a key truth. Retirement finances need periodic attention, not constant worry, but steady, thoughtful awareness. Another avoidable mistake professionals notice is outdated contact information. As agencies modernize, communication increasingly depends on accurate records, and if a notice goes to an old address or is tied to an inactive account, valuable response time can be lost. Something that could have been settled quickly can become complicated simply because the message was missed, which is why organization plays such a powerful role. Keeping tax forms in one place, saving benefit statements, and maintaining a clear record of withdrawals can turn tax preparation from a dreaded chore into a manageable routine. And many seniors say this habit restores a sense of control. Instead of reacting to surprises, they feel prepared, and that readiness supports a retirement defined by dignity, independence, and security. The big takeaway is clear. Reporting runs faster, income matching is more detailed, and even small financial choices can carry broader implications. Timing withdrawals matters, supplemental earnings should be documented, and preparation remains the simplest path to peace of mind. Most importantly, knowledge helps protect the future you worked so hard to create. Carry that understanding with confidence. Let it guide your next financial review and share it with someone who may still be unaware. When seniors support one another with reliable information, communities grow stronger. Rules may shift, but the goal stays the same. Protecting stability and ensuring the resources you depend on continue to serve you well. Stay attentive, stay organized, and remember that informed decisions help secure the comfort of the life you built. Now watch this. The change is not a single dramatic moment you can point to. It is a faster, tighter method of cross-checking that treats every reported dollar as a data point that must agree across systems. And that is where simple oversights can turn into headaches. When income streams arrive from different places and on different schedules, the paperwork can feel scattered. So the faster matching process leaves less room for someone to realize, late in the year, that their totals shifted. That is why a withdrawal that seems small in the moment can matter more than expected, not because the action is wrong, but because it can nudge the overall income picture and change how benefits are taxed. And the more quickly the IRS sees the full picture, the more quickly it can question anything that looks off. If a notice arrives, the stress response is understandable, but a calm, step-by-step approach is usually the best path. Verify the message is real, read it slowly, compare it with your own records, and respond within the allowed time rather than reacting in fear, because most issues are administrative and solvable, even if the language sounds severe. And since corrections can take patience, it helps to create your own paper trail. Save letters, keep copies of what you submit, and write down who you spoke with and when, so you are not relying on memory if a situation stretches out. The same principle applies to side income and digital payments. Staying active, selling a few items, or earning modest amounts can be perfectly legitimate, yet accurate documentation keeps those efforts from being misunderstood when reporting systems are more thorough. For retirees who prefer stability, the best protection is not constant anxiety. It is simple awareness. Know your income sources, understand that rules about taxability are tied to total income, and remember that technology speeds up matching, which means errors surface sooner and require quicker attention. Financial counselors keep repeating a practical theme. Retirement comfort comes from planning distributions, not just accumulating savings, and the newer IRS environment rewards the people who take a moment to think through timing before moving money. If you handle taxes on your own, that can be done successfully, but it becomes even more important to slow down around bigger one-time decisions, because a single year with higher income can echo into other areas, including the share of benefits that becomes taxable and the income history used in later calculations for things like Medicare premiums. If you work with a preparer, be ready to bring complete information and ask simple, clarifying questions, because the goal is to make sure every stream is captured accurately and nothing is left floating. And as modernization continues, keeping your contact information current, addresses, accounts, and whatever channels you actually check, can prevent a small issue from turning into a long-running mess simply because you never saw the message in time. Seen from that angle, the rule is less a threat and more a reminder. Organized records, careful timing, and clear reporting protect the stability you depend on, and they reduce the odds of penalties, delayed refunds, or drawn-out corrections that drain energy and peace of mind. Char count 18146.